So let's talk a little bit about Generation X. Now, Generation X is in that precarious state between the new economy and the old economy. The old economy used to be where employees could work for the same company for 40 years, collect a steady paycheck, ensure that they would have career progression, and then collect a pension at the end of their tenure. Nowadays, you have to essentially jump from company to company, most likely to have any sort of career progression. In addition, you're responsible for your own retirement. You have to set up your own 401k. You have to get your own taxable brokerage to create the retirement income at the end of your career. Now, if you look at the stats, the general plan for most Generation Xers is to simply just continue working and never retire. And as depressing as that is, it's also not realistic. Everyone's body will eventually give out. People get old and they have other priorities that they may want to focus on. So rather than just giving up, my hope is to present at least an option for people in that situation where maybe they're getting close to their 50s and they feel like maybe they're behind and they're never going to catch up. But there's always time to start something, start planting that seed for your future retirement. So that's the goal of this video. Just to show an example using, things from the FIRE community. So this is a community of individuals who try to retire within 10 to 15 years. You can apply that same philosophy to a late retirement. So if you're starting your 50s and you only have 15 years to go, then this is a potential path you can take to get to your ultimate goal. So let's get started. Let's paint a realistic picture of the type of person we're talking about.
I'm too old for this shit.
Let's say they're in their early 50s and they have a 401k balance of $46,000. Let's say they want to be able to pull $40,000 a year from their investments. Now, this is separate from Social Security. This would be the money you could safely withdraw without worrying about running out of money. So the first thing and the hardest thing to do at this point is to review your expenses. And these aren't things like going to Starbucks or buying alcohol or whatever. No, these are your big expenses. What is your housing expense? What are your vehicle expenses? And these are the true drains on people's ability to build wealth. So if you have a larger house and you had kids at one point, maybe it begs the question, should you downsize? Or should you rent out some of those rooms or do something to get out of that heavy cost burden? Because you have things like property taxes, you have insurance, for the vehicles, you have auto insurance, you have depreciation. You have all these factors working against you for these big ticket items. And seeing what you can get rid of and clean out, I think is the first step here. And it's important to start here because $1 saved is worth a lot more than $1 earned. Because every dollar you earn, you're going to pay taxes on it. And when you reduce your expenses, that's a dollar for dollar drop. So that's the main priority, I think, for someone in this situation is to see what they can do to kind of minimize those. In addition, if you have credit card debt, you'll want to prioritize paying that off, even if you can handle the month-to-month payments, because those balances are going to grow at a higher rate than most investments, to be quite honest. So you'll want to knock those out. And, there are a lot of personal finance gurus who have pretty decent programs. I think Dave Ramsey has the 7 baby steps that are pretty easy to follow. I don't agree with him on all of his financial positions, but I think getting out of debt is something his team does really well. So definitely check out his website or his book, Total Money Makeover. And I think it'll help you get to zero pretty quickly. Now that we've reviewed your expenses, hopefully you have a plan to mitigate some of those. And if you're in your 50s, you're probably in your prime earning years. So hopefully just mitigating the expenses was enough to free up your capital to make good investments into your retirement plan. But if not, then there's still a few avenues to look at on the income side of the equation. So the first thing to do is, are you an hourly employee? Can you work overtime and get paid time and a half? Or are there things that you can do in your company to qualify for maybe more bonuses? Or if you're in sales and you get paid by commission, maybe there's a way to improve your sales capability and look into generating more prospects than you have historically. So there are opportunities within your career to get more money, but it really just depends on kind of the company you work for and what your skill set is. So the other route is entrepreneurship. And I'm hesitant to recommend entrepreneurship in the sense that, it's not an all or nothing thing. I think people can be entrepreneurial without kind of betting the farm. So you can continue to do your career and make money in the way that is tried and true. But then on the side, you can explore, additional opportunities to make more money. If you're in your 50s, you probably have an idea of what the gaps are that exist in your field of expertise. So if I'm an accountant, for example, I know that there's an annual audit, and a lot of companies will outsource the preparation of the audit support. And, that's an opportunity for you to step in and say, hey, I can do that for $75 an hour, $80 an hour. That's a lot cheaper than having the accounting firm do it for the client. So a lot of them will take you up on that offer. And that's from me kind of being in business and kind of understanding the business cycle as it relates to the audit. If you have some technical expertise, maybe you're really good at Photoshop or Adobe Premiere or Microsoft Excel or SharePoint, there's a website called Fiverr where you can essentially sign up as a freelancer and start selling your services on the side for technical skills that you have to deliver an outcome. So the key takeaway here is that with experience in an industry, and as you kind of expand your expertise, these gaps will become apparent, and it's up to you to take advantage of those gaps and deliver those services. And it's not an all or nothing thing. Like I said earlier, you can continue to work your day job and then expand this side hustle, delivering these extra services for money. And who knows, maybe you'll make more money in your side hustle than your main job at some point. But you don't have to take the risk of, all or nothing. You could do both to get to your final goal. So assuming you've done both of those exercises, you've looked at your expenses and you've cut out a lot of the fat, and you're looking at your income and you have some ways of kind of producing additional income, then you can try to figure out what it takes to get to your end goal of producing the $40,000 a year. Here we have a couple of assumptions. So ROI assumption is basically what we expect our investments to return each year. We have an inflation rate, and what this is going to do is grow our future withdrawals. We have a target income in retirement. So this is the $40,000 we were talking about before. Starting age 50, ending age 65, and then the starting amount. This is what was in the 401k we said, so $46,000. So based off of this, we see that our required contributions to reach our goal are $34,744.07. And if you scroll down, we see kind of the end being $1 million. And, depending on what your current situation looks like, if you were able to reduce your expenses by $34,000, then this is relatively easy to hit. But if you still find that there's some gaps to grow, you can take this and kind of make changes to what your contributions are and see how it affects things. So let's say you can only really contribute $5,000 the first year. And, it's going to take time for you to reduce your expenses and to grow your income. And we're going to say, every year you achieve an additional $5,000 of savings. And so what I'm doing is just overriding these formulas. So you can see, even if you don't contribute the required amount, you still make a lot of progress towards your goal. So instead of the $34,000 that we said we needed to calculate, you're getting, $5,000, $10,000, $15,000, and all the way up until you get to your final goal. So at 65, you'll have $760. Now, it doesn't seem like much, but if you take that 760, 283.15 times 0.04, you can still pull out $30,000. And that 4% rule is based off the Trinity Study, which I'll link to in the description, but essentially means, you could safely withdraw 40% or 4% of your nest egg and have some expectation that it won't run out. So $30,000 plus maybe $20,000 in Social Security, that gives you about 50 grand a year to work with, which is very doable, I think, for a lot of people. And I'll link this spreadsheet in the description. And I made this so that it's pretty flexible for doing kind of what if calculations. So, you could change it to 25 and then it'll calculate these. You could change your nest egg to 0. And then you can kind of see what, a 25-year-old would need to contribute to get $1 million by 65. You can even move up the requirements. Maybe you want to retire by 40 and you're starting at 25. Well, then your contributions look a lot like someone who's starting late, starting in their 50s and wanting to retire by 65. The other thing to keep in mind is the fact that if you're in your 50s, you are eligible for catch-up contributions. And what this means is the IRS gives you the ability to contribute in excess of the normal limit for 401ks. So for your 401k, you could do an additional $6,500, giving you a total contribution of $26,000. If you're doing a Roth IRA, it gives you an additional $1,000, so a total contribution of $7,000 in Roth. Combine the two, you have about $33,000 you can contribute each year with tax advantages. So definitely take advantage of that as you're trying to accelerate your exit strategy out of your work life. So hopefully if you're watching this, you realize that it's never too late to start. Even if you're starting at 50 and you have a quick timeline of getting there by 65, you can still make a lot of headway to what your ultimate goal might be. Even at 50, you have 15 years of compounding working for you. So that $5,000 is going to compound 15 times before you're at the age of 65. So if nothing else, take that first step, invest that $5,000, and grow it as much as you can over the course of the remaining period of your career. And that's all I had to say. So thanks everyone for watching.